Hello and welcome, everyone. Thank you so much for joining us for this month's State of Freight webinar. My name is Julia Becker. I'm the Vice President of Media Operations here at FreightWaves, and I'm joined in studio by Craig Fuller, our CEO and founder at FreightWaves and SONAR, and Zach Strickland, Head of Freight Market Intelligence at SONAR. Today's conversation will cover the latest insights from our SONAR platform, as well as a look at what's ahead in 2025. But before we get started, I want to cover just a couple of housekeeping items. If you have any issues during our webinar, you can reach out to our team via that audience chat function in your webinar console, and we'll be in touch to help you out. If you have questions for Craig and Zach, you can enter those in that Q&A box, also in your console. We'll save time at the end of our discussion for as many questions as time allows. We'll also send a link to the recording of this webinar tomorrow in case you want to watch it on demand or share it with your colleagues. Now I'll go ahead and turn it over to Zach to kick us off. Let's jump right in, Zach.
And thank you so much for that, Julia. And thank you for tuning in to this month's State of Freight. I'm Zach Strickland here with our CEO and founder, Craig Fuller. And we're going to talk about the biggest issues in the freight market, global supply chain environment. And Craig, my first question to you to lead things off for this January is, what do you think is the biggest story in freight to start the year?
I mean, tariffs and new administration is probably the biggest story because it's going to determine everything from here on out.
Yeah.
How does the administration handle any kind of issue, whether it's government employees? You know, government is the only entity that actually has the ability to impact the freight market en masse quickly. And so whether it's monetary policy or fiscal policy, those things matter. Mm-hmm. And this is all about sort of government policy and all the things that are happening really quickly under this administration.
Yeah, I think one of the things we've talked about, and things I hear from our customers and just the world in general, is there's like this big cloud of uncertainty in the world right now, especially around global supply chain environments. We've got some conflicts resolving. The Red Sea, the Houthi thing is kind of dissipating a little bit, still not completely there. And then there's the tariff situation. We've got two. The tariffs seem to be kind of a sticking point, not in the sense that like people are almost, yes, they're concerned about the fallout, but it's almost like people not having a resolution or a definitive answer about some of these things is causing a little bit of fallout in that. Do you think that that's accurate?
Yeah, I think the bigger question is what's next.
Yeah.
I think if you learned anything from Donald Trump's first administration is that even when you think things are settled, they're not. He's always negotiating his mind. Now, some will disagree whether that's fair or not in terms of whether this is the right way to negotiate when you're dealing with policy. But in his mind, he's always wanting the upper hand. And look, whether you like Donald Trump's policies or not, he has found that particularly smaller countries that are heavily dependent upon the United States and trade to the U.S. will cave pretty quickly when there's a threat of something demonstrative like we've seen. I mean, Mexico has backed down, has changed some of their policies, and really sort of changed the way that they're operating. And we've seen that also with Colombia this past weekend. I think that is becoming probably the big story and I think what this means is that if you're running a supply chain, you really are not going to be able to catch your breath because there's always something. I mean, look, at the end of the day, Colombia, even though it's off, somebody could piss off Donald Trump.
Right.
The Colombian president could say something, and all of a sudden it's back on. So that is the unpredictability which is going to govern so much of policy and policy decisions, particularly when it comes to trade over the next couple of years.
Yeah, and Colombia was relatively small compared to the upcoming February 1st deadline.
Which is what? Talk a little bit about that.
Yeah, 30 to 40 million was Colombia, and then we've got, I think the billion, I should say, and the next layer of threatened tariffs, which are going to be levied potentially or threatened on Canada and Mexico as of February 1st, which will be this Saturday, could impact as much as $300 billion.
I think it's even more than that.
Yeah.
I mean, Mexico alone is something, it's like a couple, 500, 600 billion, I think, in total U.S.
And he's talked about a 25% tariff.
And then you have Canada, which is also in that ballpark. I mean, these are China, Canada, and Mexico are the top U.S. top trading partners.
Right.
Obviously, Mexico and Canada are vulnerable to U.S. trade. The U.S. market is the largest consumer market in the world. They are, in many ways, the fact is that the U.S. does not export as much as it imports from those countries, and their entire economies are built around exporting to the United States. And so because of that, you have a lot of vulnerability in Canada and Mexico. And I think what everybody looked at God, I hate that term, USMCA, or NAFTA 2.0, as we'll say. Everyone looked at it as it was a Donald Trump policy. We've talked about it, and things were relatively stable, but he has threatened 25% tariffs. If you follow anything in Donald Trump's, you realize that oftentimes he makes a huge threat and is happy to take some type of someone once said to me, never underestimate Donald Trump's willingness to accept victory at any moment in time.
Yeah, I read an interesting coverage piece. There was a webinar that Noy Mahoney covered with Cooney Nagel, and they basically talked about how this felt a lot like a negotiation move, and that we're not necessarily going to see tariffs levied this weekend.
Well, we didn't. I mean, if you go back to the previous Trump administration, even when we're talking China, there was like this big, I'm going to put these massive tariffs.
Right.
We saw a number of exceptions that came out. There was a big threat, and then it backed off. There was probably the best story I can remember that was when there was a lot of back and forth over Donald Trump's wall. Remember during the election in 2016, during the campaign, he talked about I'm going to put up a wall, Mexico's going to pay for it. It became this sort of like punchline. And he basically made the point, you're going to pay for my wall, Mexico. Mexico's like, wait, we're not doing that. And so it was a shot across the bow. Right. He said, hey, if you don't close the border in a week, I'm going to levy tariffs on Mexico. That ended up basically not happening.
Right.
Largely because there was some consideration given by the Mexican government that made Donald Trump feel like he could declare victory. And I think that's what we'll see here, is there will be concessions being made. Like, one thing I will say about the Trump administration this time around, whether you like it or not, and depends, and maybe government, for all of its ineptness, I think we're seeing a much more rapid and effective Donald Trump policy and administration this time around. Like it or hate it, it's happening.
Right.
They're a lot more, they're a lot less dysfunctional than they were the first time around. And that's scary for people who don't like Donald Trump's policies, encouraging for people that do. The fact is, these are far more and far quicker than decisions than what we saw the first round. He did not have the broad political support from the populace and even government officials that he has now. And even the administrative class, the bureaucratic class of the government was in many ways fought him.
Right.
This time he's putting out enough pressure and incentives, both sticks and carrots, to actually, I wouldn't say gain support, but sort of drive a train right through the middle of some of that bureaucratic red tape.
Yeah, to me, it's a lot of noise to follow because it's hard to tell what exactly is going to come out of it. It's an extremely complicated web of politics too. So I want to transition. You know, John Kingston always told me, never bury the lead. I feel like that was the lead. Let's transition into the freight market a little bit here and talk about, we've had a lot of earnings come out. J.B. Hunt, Knight Swift, all of them have kind of a cautious optimism veiled in there. J.B. Hunt maybe less so, but I think Shelley's also playing a little bit of a game.
Shelley, by the way, she's arguably the most seasoned CEO. Like, the thing that's about Shelley, she worked way up. I mean, she was, I think at one point, like customer service rep. She built their brokerage business. Like, Shelley's been around. I don't want to date her because she's not supposed to do that. But she's been around a couple of cycles. Yeah. And but she's arguably the most seasoned trucking executive, big public. And look, J.B. Hunt's business model has changed so much over the years. Yeah. She's seen this cycle before, and I think her caution, my read on it is, J.B. Hunt likely, if you looked at their earnings, a lot of it was actually the brokerage business was down in revenues. A lot of that, the way I read in it, is they were probably exiting some of their less profitable contracts.
And profitability was up.
And yield, they were trying to, knowing that if the market inflects, as we think it does, that they don't want to have some of these lower paying price freight. And so they're willing to sort of when US Express was public, my father sort of taught me this when they were a public company, is like, when the market really sucks, when things are really bad and your stock price is already beat up and you're not going to get any credit for victories from the public market. You might as well you end up seeing this with certain companies where they'll shut down or sell off bad performing assets and take a charge off during the down period because their stock price is already beat and sentiment is so bad that just take as many of lumps as you can during the down period to sort of build a much better and resilient enterprise going forward. I would read into it to say that her caution, she's not going to get a ton of upside for being overly bullish. But if they come in and have a really strong 2025, that can build the next part of the cycle. So they're actually positioning themselves for a really big upcycle. And that will help drive the stock price, which I think is quite brilliant.
I agree entirely. So let's look at the outbound tender rejection index. It's, versus where we were in December. We were talking about seasonal disruption in December last time we were talking. The rejection index in the white line there for the current year, 2022's in green. The fuchsia line there is 2023. And then I'm making up colors at this point.
I think it's like magenta. Is that fuchsia? I guess it is fuchsia, right?
And then the tealish blue one is last year. We are significantly higher than where we were this time last year. And if you recall, we were actually still coming out of that winter weather situation. Last year, you could argue a little bit of the same this year. Night Swift even referenced this year as we had winter weather pull some green shoots out in January that they don't expect to persist. But Craig, we've had a week now, and the last winter storm that we had really didn't hit freight heavy markets. What's your read on a 7%-ish rejection rate at the end of January this time?
Look, I'm still bullish. I said, back in November 8th, you reminded me of that. It's my brother's birthday, it's how I remember it. We came here and talked about the Great Freight Recession is dead. I think that thesis is held. There's nothing to actually contradicted it, in terms of like, you could be cautious and you could say, hey, I'm not seeing the super fast V-shaped recovery that we saw during the early parts of COVID. I don't think we even said that was going to be the case. But the idea that the market is the worst is behind us, I believe largely. And we're seeing some follow through in January. I've been burned a number of times over the last couple of years by being really bullish in January when things do collapse.
It has thrown some false signals at it.
But I think if you look at all of the data, you look at other data points beyond tender rejections, you look at even the anecdotes we heard from public companies, there was a level of optimism when they're talking about rate cycles. So take, Heartland had its earnings that came out last night. It was interesting, Heartland lost money again this quarter, which is really unfortunate for a company that used to be in the high 70s, low 80 OR, that it's had a couple of bad years. But what you did garner from that, Night Swift as well, is that the negotiations, even J.B. Hunt, as cautious as they were on their call, talked about they're seeing some of their shippers start to get it ahead, award business, potentially, and arguably at higher rates, earlier in the cycle, earlier in the year than they have in the past. And that suggests to me that everyone is sort of positioning themselves for a better year. And I don't think, if you're a shipper, I think the risk is more on the fact that you could run out of trucks or having to pay high spot rates. And so that those gains that those carriers have earned this part of the cycle is unlikely to be pared back, short of some catastrophic economic event. One thing I will say, and we've talked about this a number of times, and this is I hate going back to politics because I don't want this show to become a political show, but I would say that the deportation, and even if the numbers are not, I think a lot of this is more theatrics as much as it is anything, because if you look at the number of deportations we had in other administrations, short of not talking about the Biden administration, but during Obama, during the Clinton administration, during Bush, is the numbers themselves don't seem to be the big issue. Yeah. It's the optics of this stuff being public. A lot of the deportations under Obama were not in public, and they're very, very public. But you look at the number of border crossings that have taken place; those are way down. And I think what this is doing is it's changing the composition of our workforce in blue-collar jobs. And I think whether or not that pulls truck drivers leave the industry because they're either afraid to leave the industry or are afraid to be deported or could be deported or will be or are being deported. I think the issue is that the jobs that trucking competes with, construction, hospitality, food, manufacturing, agriculture, those businesses are losing people. And when they lose people, those jobs become competitive. And so we will pull some capacity out of the market because drivers are ultimately the determinant of capacity. And I think that's the story that should live on. And we've talked about this before. Yeah. I have increasing conviction. When people first mentioned, illegals or undocumented workers taking jobs, I kind of dismissed it as a bit of xenophobia. Mm-hmm. I have my son is half Colombian, and so I spend a lot of time in the Latino community. So I'm sensitive to a lot of the sort of comments that people make. And I sort of dismissed it, but as I went on the journey of trying to understand it and talking to people who I consider in the know, people that work in insurance companies, people that work close to this stuff, it's a bigger issue than I think we have it's been off the radar.
Right.
Part of it becomes such a polarizing political conversation, but part of it is like, it's so sort of on its own that it's hard to sort of see it. I think it's a much bigger issue and has probably kept capacity availability exacerbated more so than even we've given it credit for.
Yeah, I know in other industries other than transportation, they've cited the immigration as kind of a gap filler over the last couple of years.
Yeah.
We would not have had as strong of economic growth in certain situations without that supplement because we're not producing enough people for labor.
Population growth is an issue, but I think what you end up with is when you have folks that are sort of below the radar, mm-hmm. some of that has exaggerated this capacity build. We've talked about all the reasons. I think that is a factor that is probably underappreciated. And there's multiple stories of everything from Ukrainian refugees driving trucks to Mexican trucks crossing the border and not actually going back to Mexico, coming under the NAFTA or USMCA pass and then just staying.
Right.
Even violating cabotage rules. Or I heard an example of this is come across the border in a Mexican truck, and then they get to the U.S. and they're given a U.S. truck with U.S. operating authority, and they drive that truck. And as long as they don't get pulled over, then there's not really anyone to get mad at them.
There's nothing.
And
nothing
so
to call them.
That is happening. One of the things I will say is in some ways, I wonder how much of a refuge, frankly, truck driving is if you're worried about deportations, because if I'm working at a chicken plant, per se, mm-hmm. then ICE is more likely to raid a big plant than it is to find me on a truck.
Exactly.
In the truck. So actually, this could be an interesting play.
Well, capacity has been leaving the market, and we see that in our net changes in trucking authority data that Carrier Details helps us clean a little bit of. And the way to read this, anything in green is a net growth in operating authorities. Anything in red is a net negative to total operating authorities as held by the FMCSA. This index biases towards growth always because people are fast to enter and slow to exit. Mm-hmm. And we have seen historic exits after what was, of course, historic growth.
What I'm encouraged about this, Zach, is look at the mountain, the green mountain, mm-hmm. and look at the red caverns. And so what you see is, now the red mountain is much higher than the sort of the depth of those caverns, in red, where people were leaving the industry. Mm-hmm. But the length of time, I mean, if you go back to this data, we saw growth really from April of 2020, sort of the start of COVID. Mm-hmm. If you look at this chart, basically it ended, or the expansionary cycle ended in the third quarter. It looks like October, mm-hmm. maybe July, even August, a period of 22. Right. That was a 2-year period. We are now in that 2-year period of the contraction part of the period, and the economy has grown. Right. So we've seen some expansion. It certainly suggests that and what is interesting is a little bit of growth last year. See the green lines that are popping up. It's now come back down, and I think that's just capacity continues to leave the market. Someone asked me on Wall Street, I was talking to, is why if the market's improving, why are people still? You get asked this question
all the time. I'm looking forward to this.
If things are better, why are they still going bankrupt?
Yeah.
Or why are they? That was actually the question. I'm like, well, they don't just decide to go bankrupt.
Yeah.
I guess technically you could decide to go bankrupt, but they don't have an alternative.
It takes a very long time for a business to fail.
It does. I like to say the balance sheets have memory.
Yeah.
And the operating deficits of the past years, you could have an improving situation in the market and you still have all these operating deficits that you have to contend with. That is the reason the market can still be in decline. Right. One other thing to point out, and I've talked about this, I don't know if you and I have talked about it, but I've certainly talked about it to people that I've spoken with, is when the market inflects up, when the market improves, it actually exacerbates the bankruptcies. They actually accelerate into the upcycle for two reasons. The equipment now is more valuable to the banks because they feel like they can sell it and flip it, so they will repossess it.
Right.
When the market sucks, they don't want the equipment,
right.
But when they're starting to see some demand, they can flip it. So when you see a firming of residual values, they're like, hey, we can actually liquidate this equipment, which is one thing. Frankly, getting half your money on a payment is better than nothing at all. But right now, they feel like, hey, I can liquidate the equipment. That's the first thing. The second thing that's going on is that the truck drivers of some of those weaker carriers start going to the truck stops and talking, say that you and I were truckers, or let's say that I'm working for a carrier that doesn't have a lot of freight, and I come up to you and you're working for a high quality carrier, working for JB Hunt. Right. I'm hearing how great JB Hunt is running you. Then I may say, hey, I'm going to leave Jim Bob Trucking to go work at Hunt and leave and go work for you because I'm going to get more miles. And this is the part of the cycle where you start seeing drivers hearing about certain carriers are keeping them running because they have higher quality freight than others. And it starts to create this migration path. And so that eventually puts these guys out of business. The other sort of factors in this are insurance. There's a renewal period for insurance because we've gone through just another year. Insurance and prices are continuing. Insurance inflation is real. Insurance companies are going to get their risk management, even things that don't directly impact it, like natural disasters do show up where they feel like they can extort these opportunities. The other thing is like plate renewals for certain states. These happen in rotating things, but they're coming up again. When you start having years upon years of operating losses, that stuff adds up, especially when you have these events that tend to take place. And so that's why you tend to see these businesses go under faster. Right. Plus, we're back to the days of nuclear lawsuits being a real factor. Right. And there's a period during COVID that the amount of payout was lower. But a lot of these carriers that have been operating deficits haven't been maintaining their equipment for a couple of years. They've been running this old ratty equipment for years. Yep. That adds up in maintenance costs, that adds up in downtime. Shippers also with a new renewal cycle and bid cycle are thinking about whom to do business with. There's a lot of reasons why you can still have an enormous amount of failures on the front end of a recovery.
Right. I want to pivot a little bit here. We talked about capacity. It's leaving the market. It continues to leave, and it probably will leave for a while, even if, like we said, some of the fundamentals of the freight market have improved. Now, the one fundamental of the freight market that's starting the year off a little bit below expectation, maybe, depending on how you look at it, is the demand component. The outbound tender volume index that I want to pull up here, it's a tender volume index based on the total number of shipping tenders, shipper to carrier, and they say, will you haul this load for this amount or not? The carriers will say yes or no. There's other few options, but this is a demand side indicator. And right now we are operating below where we were this time last year. And this has happened sort of for the last couple of months-ish. If you look at the difference between the bluish teal line and the pink line in November, December last year. Some of this, of course, loss of share. Do you have any real concerns here? Because we're losing, demand is underperforming year over year from this index's point of view, but tender rejection rates are up.
I'm encouraged.
Okay.
Because what we're seeing in firming of rate, higher rejection rates, the spread, which we'll talk about in a minute, I hope, the spread between contract and spot. We're seeing all this stuff happen where we had some other data points beyond volume suggesting that business is stronger, that the market is stronger. And yet volumes are not reinforcing it.
Right.
And I think that's actually should be really encouraging, because it means that capacity situation, the amount of trucks available to haul the amount of freight, is largely leaving or has left the industry. And I think that means that the level of sustainability, that inflection of getting back to a normalized market, if we can call it that, is far more is happening. And I think we should all be encouraged by that. Now, we're not seeing huge surges in demand. We're not, as you see in the chart. You did see that could be some timing with the weather. You saw this big drop.
The Martin Luther King holiday.
That you see, I think, Zach, frankly, is the weather. That big
Well, that's
dip
also
in
Martin Luther
white.
King has
MLK
has become a much bigger holiday in my mind.
It has, especially after the whole COVID and all that movement, as people felt, that. And so that is a much bigger holiday than it used to be. It certainly gained momentum. But you also have winter weather has played into this.
For sure.
We've had this has been one of the coldest winters, Texas. And
January
Florida
was very cold.
And so I think some of that's playing out. But I would say overall, I'm actually quite encouraged by where we're at as an industry, in spite of the fact that volumes haven't been too strong.
Yeah, and this trend line is different. If you actually kind of look at, it's volatile.
It's a breakout.
But it looks like it's starting to trend up, pick up a little bit in the days.
Well, it's very well the next week, we could see the white line cross the green line.
Right.
And then you will say that it's an expansionary period. Short of you're right, because MLK does, but I think even when you look at that, you do have some winter weather. That these storms are pretty significant this year, much more so than we've had in years past.
Yeah, cold weather going all the way to Gulf. Of course, it's Lunar New Year now, so I think we'd have to talk a little bit about total demand in the context of our inbound ocean TEUs index. That, of course, I'm going to try to pull up here. But the inbound ocean TEUs index, which they do have for us, is a measure of containers that shippers are ordering from across the ocean all over the world that are coming into the United States. And there we go. And it's doing as well as it did this time last year, if not a little bit better. Because
it's doing better. Look at the white versus the green line. It's that inflection period. Chinese New Year has a pretty big impact on where this lands. You see a big drop off. These are, remember, bookings. So that freight has not hit U.S. shores. It's still in the process of sort of coming. When you look at this data, it does suggest that things are stronger than they were. That makes sense. And really, two things, we've talked about it before. Obviously, restocking or inventory pre-stocking is an issue. But I think that is actually, if it were just pre-stocking, then inventory levels would be much higher than they are, because companies are taking possession. That does not explain everything. Right. And we've talked about this. It's less reported because Americans are so focused on America. But if you look at the Chinese economy, it is actually it's highly distressed right now.
Right.
Chinese consumer production's down. Now the Chinese government is doing some stimulus. They're trying to change to actually do some things. They sort of recognize they have a problem. But what's happening is China's whole economy is based on really driving exports. The American economy is based on consumption.
Right.
Some would say conspicuous consumption that isn't needed, but neither here nor there. The Chinese economy is not based on that. It's all based on exports. And so what's happening is China's currency is under pressure because of Donald Trump's tariff threats, but also the Chinese government is really trying to promote exports so that they can secure U.S. dollars effectively. Right. And because of that, and in many ways, the Chinese currency is depreciating against the U.S. dollar. That is driving the export market. U.S. retailers are going to China to shop at significant concessions. And this is another thing that we talk about is it is not the small companies that are driving the predominance of volume. It's the big companies that have the balance sheet, the wherewithal, the negotiation power, and they can do a deal. So if you walk up to a small vendor or a small importer and you say, I'll give you a concession on price, they probably would not take advantage of that if they didn't think they had demand. However, Walmart, you say that to Walmart, Walmart's like, let's go. Let's do it, because they can take advantage of it.
Right.
And they do have ways to move it through their supply chain. And that is what's happening, is the bigger companies are taking advantage of these significant concessions. There is some like pre-stocking of raw materials, like steel and other things that are certainly being pre-stocked. But I think the story is that the Chinese economy is weak, the U.S. economy is strong. That is driving a lot of the fundamentals, and it's not just an inventory pre-stocking.
Yeah, we actually talked to Dr. Zach Rogers a few weeks ago on Freightonomics. If we want to pull up the LMI inventory levels component of the LMI, and you can see that it's a 50. That means that there was basically no change in total inventory levels from November to December, because this is December data that we're looking at. Now, he broke this down, Craig, and he says basically he agrees entirely with you. The data agrees with you as well by saying that upstream inventories actually showed a little bit of that pre-stocking growth, that pull forward activity at a 57, which would be slight expansion. Downstream, during December, the number was 33.
It's because all these retailers were liquidating.
Just complete fluidity, and that number actually tells me their demand forecasts were here, and demand was actually a little bit higher.
Everyone, I think most folks, if you go back to last year, there was a lot of concern about the U.S. consumer.
Right.
There has been for 2 years.
Right.
It really has been since 22.
Because of the debt, largely.
Well, it's
and
consumer
inflation.
debt. Consumer debt, inflation. A lot of retailers position themselves for caution.
Right.
At least publicly about cautious about consumer spending. But what you actually saw them doing is taking advantage of a lot of product, and they were able to discount. I mean, you did start to see some sales happen this holiday season that you had not seen in past years, because they were able to get things on wholesale prices cheaper. And they were able to move those products. The U.S. consumer has been resilient. U.S. employment has been resilient in spite of the freight market experiencing some pain. And that has allowed them to continue to flow products in and out the door. And those turns have enabled retailers to take advantage of imports activity. So what's really interesting about this is you have record levels of imports coming in, and we're not seeing it it's not these retailers it's not sticking in their warehouses like we saw 2 years ago. And that's been the fear that everybody had, is this going to create an inventory overhang? We're not seeing that. There's no reason to think that there's an inventory overhang. In fact, when you look at the freight market specifically, and you look at markets that saw some level of record demand in the fourth quarter, Phoenix, Arizona, Southern California, it was those intermediate distribution points really were cooking because the importers had brought that inventory in and were moving it. And I think that's a really encouraging sign. And if you want to be encouraged by all this, it means that if you go back, you got the chart right here, you got it right here, is the fact that inventories are starting to, I wouldn't say contract, but balance, is suggesting that we don't have an inventory problem in spite of record import levels.
Exactly. I think that's the point.
I think we should all celebrate that, because that's huge. One other thing is the Federal Reserve was on its, it was positioned for interest rate cuts. It stopped. I think everyone on Wall Street sort of recognized in late November, really after the election, in December, that rate cuts were unlikely to happen. The Fed's orientation has shifted because inflation, I wouldn't say it started cooking again, but it started to level out.
It did have a little tick up
small
there.
Small ticks, but largely due to energy prices. What we're seeing now is a situation where the Fed's not going to be cutting interest rates. The economy feels like we're kind of imbalanced.
Yeah, like in a reasonable way.
And I think a lot of banks were positioning themselves, certainly when you look at the financial markets, were positioning, expecting Donald Trump's policies to drive inflation. And so a lot of the 10-year
bill
was basically pricing in higher cost of capital, which has really kept the Fed from aggressive.
And also keeping mortgage rates up.
It is, and that's an unfortunate reality.
So total demand, we talked about it from an import level, and it's like, well, Craig, there's, we're not, you just told me that trucking demand was a little down, but imports are high, inventory fluidity is showing up. One of the things that has happened over the course of the last 6-7 months, intermodal has been booming. And it's really taken a little bit of a chunk. And I think this is something that I find fascinating because everybody, when I talk to people in the space, they're talking about, well, how many trucks are there? Where's the trucks going? How many trucks are leaving? Nobody ever mentioned to me in June last year that, well, they actually grew capacity in the intermodal market by 5 to 10%.
I wrote about this years ago. I think I've only written about it once, maybe twice. It's something called dispatchable capacity.
Yeah.
Which is like the intermodal market and the trucking market are largely interchangeable in terms of capacity. It's total capacity units. The other part of the market that we haven't talked a lot about is private fleet.
Right.
Private fleet's expanded exceptionally over the last couple of years, and the amount of capacity that they brought into the market added. So you've got intermodal that's been incredibly strong. Those are boxes moving. We've talked about this before, is like, those are warehouses on wheels or on chassis, but they're moving. It's moving warehouses. And that has enabled a lot of shippers to take advantage of slow trains, slow movement of cargo, because it's not sitting in a warehouse, is they can sort of enjoy having access to inventory that they don't need immediately and don't have to pay warehouse rates short term.
So my next question to you is this a sustainable mechanism? And do you think that intermodal, like shown in this chart, the white line is loaded container volumes moving on the rail, continues to look like it's taking share from the trucking market? 6% year-over-year growth there versus the negative 1% on the trucking. Do you think that this is a mechanism that can continue and persist?
I mean, look, I think the railroads have their act together. They didn't necessarily have it a couple years ago. They were really shocked by COVID sickness and illness and crews being out. I think they have a brand new contract that, relatively new contract, we'll say, that actually favors labor quite a bit more so than it did in the past. I think the crews largely are supportive of where the railroads want to be. The railroads have gotten their act together. They're smart. They're taking advantage of these opportunities and these inflection points. The supply chain is far more orderly than it's been.
Right.
Like, one of the nice things about having imports and preparing for these demand shocks due to tariff changes is that you do start thinking about buffer stock and having a resilient supply chain. And that favors intermodal better. I don't think, this has been talked about some, I don't think we'll see a situation where what we saw during COVID it was just chaos.
Right.
Railroads basically, crumbled under their own weight. I don't think that's going to happen this time around. It's going to be incredibly interesting to watch. I mean, these jobs, one of the things that's sort of under the new union contracts that have come in, whether we're talking UPS, the ports, the railroads, have made these jobs far more attractive. And the news around them, the media that has been talking about these jobs, the opportunities, the money, all of the stuff that goes into these jobs, have brought awareness to the types of opportunities that exist. And I think it makes the railroads, the ports, UPS, easier to find people to take those jobs. And I think that's large and net good because you don't have crew problems to the degree you had it in the past. So I don't know. I'm pretty bullish on the railroad's ability to really step up. I'm really bullish on them bringing incremental capacity. And I think it's a factor in the market. But I think generally what we want to see, if you want to see a more robust trucking market, is you want to see more exits in the trucking industry.
Right.
And we are certainly seeing that.
Yeah, and I think regardless of intermodal taking share, we've talked about it, rejection rates are going up. Well, guess what? Spot rates are also going up. And we just had contract rates go up. So, Craig, I'm going to throw up your favorite chart here.
I love to use rates.usa because it is my favorite chart. It's much better than your chart that's got 2 lines to it.
I love the 2 lines. You got yours, I got mine. Go ahead. Let's talk about the rates chart and what it means and what you're reading here, because it looks...
So this is the spread between spot to contract spread. In a normal market, spot or contract's always higher than spot. If you go back to COVID, that green mountain, again, 0 means that spot is more expensive than contract, but that green mountain means that when you see green there, it means, well, spot is higher. But in a normal market, contract's always higher than spot. And we see the delta between these 2 numbers. It got as low as about $1 a mile cheaper to move freight through spot when the freight market collapsed. And what we've been looking for is this more normalized range, 35 to 50 cents. We're at 42 cents cheaper for spot. That's where brokerage margins tend to live, is in that spread.
Yep.
And this means we're sort of back into normal range. We're actually approaching Like if you think about 35 cents being the number, we're actually approaching a bullish market. And I think we should celebrate when we do see 35 cents on a sustainable basis, because it tells us that the market is now back into balance and is starting to be a bull run. That means the shift will have moved completely in terms of pricing power from the shipper to the carrier. And I think the fact that it's approaching this way in January is incredibly bullish.
I agree with you entirely. I love the trend line on this chart.
Just up to the right.
This is exactly what a healthy transition looks like. It may have started lower than many people have wanted to, and obviously it's taken a long time, but that up and to the right is almost linear.
It is.
And
if you took a line across it, and you can do this inside of SONAR.
I think this is why a lot of carriers are hesitant to call anything, is because it's been such a
It has
slow
been a long
progression.
time. But this is, it's interesting. I had this comment earlier there's been a bit of a disagreement or a little bit of differentiating reports on public earnings reports. Some of the management teams, Landstar, C.H. Robinson, were certainly more cautious than some of the true pure play asset guys, where they don't have big logistics operations.
Right.
And the reason is what I think is happening is logistics operators tend to be more exposed to the spot market opportunities, and they're not seeing the kind of firming that they want to see or sort of acceleration of volume, particularly sort of routing guide. But what the bigger asset carriers are getting is they're getting preferential treatment in routing guides, and they're hearing from their customers, we are willing to accept higher rates.
Right.
And I think that's why you see the larger sort of true truckload carriers, which there aren't a lot of public guys left. That's why the Heartlands of the world, the Knight-Swifts, that's why Covenant they're out hearing and saying that bids are coming in sooner, faster. The data certainly is reinforcing that as well.
Yeah, I think
Sage Robinson was a little I call it mixed. But again, the other issue is when you're talking about public companies, they don't get a ton of credit for being bullish and being wrong.
Right.
They can get really spanked. And if you're a management team, you'd rather be surprise everybody on the upside than surprise everybody on the downside.
Yeah, and I pulled up my chart because I let you have your chart.
You like two colors.
I like colors, I like variety, but this is to show you, the point of this one is really going to be, because what you just saw was the difference between the white line and the yellow line. I want to talk about that white line a little bit more in this, because that is our average aggregated contract rate for dry van loads, and the fact that you can see that turn in that line, and that's happening largely without a ton of pressure from the yellow line. Now, we did see a jump seasonally in spot rates over the holidays, but a lot of these contracts that are coming in now were negotiated prior to that, because there's a lag in the contract space. So a lot of that is expectation. It's almost like shippers were feeling some of this before they
we're seeing it round up. I mean, you've got a cup handle sort of coming up on the other side of that. You certainly have seen the bottom of it midsummer.
But a 5% rejection rate typically doesn't produce an inflationary contract.
We're at 7%.
Well, 7% here now, but
I
this
see
is
when you turn around. Yeah, I mean, but I think everyone knew that the freight recession had gone on way too long, and everyone sort of waited. But it's interesting how few people. But this happens every time the market turns. Is like you have a disagreement. We had a disagreement in 20 when the market was going to turn up, and I remember people on X were like, "Oh, it's not coming back. It's dead." Some of our normal detractors were pretty bearish in the summer of 20 when we were bullish.
Right.
Even some of the public earnings calls were pretty cautious in 20, even when we were seeing improvements. The interesting thing is you tend to have a disagreement that takes place in 22. Same thing. We would hear, we were talking about the softening of the market, and some of the public guys were so big a disagreement. I think my favorite quote from that whole period was the CEO of Ford Air in September at a conference, September of 22, said, "If this is a freight recession, bring it."
Right.
And then 30 days later, had one of the worst earnings reports that they talked about Q4 being one of the worst quarters in history. In their recent history, I think that's sort of a classic line, is that they probably shouldn't have said that.
Right.
Because they ended up regretting it pretty quickly.
For sure. Well, we're running up on a little bit of time here, so I want to make sure we get to Q&A. Julia, I will pass it over to you.
Sure thing. Yeah, thanks, Zach. We've got some great questions already in, so I'm going to roll through as many of those as we have time for. This first question is from Timothy. He asks, Canada's biggest export to the U.S. is energy. What issues would a 25% tariff on that energy present for trucking and other freight movement sectors in the U.S.?
Yeah, it's all heavy crude. That old Alberta sand is really heavy.
Yeah.
It's used in certain types of products. The thing about energy and oil is that not oil is equal. Like, it has to be refined, and a lot of this is like what refinery capacity can handle it. Like, energy is an interesting thing. Certainly, if the Trump administration wanted to put heavy tariffs on everything imported, they could do so, and that's certainly a threat. My estimation is that what we will see in the end product is a lot of exceptions being made for certain types of products, oil being one of those. There's the threat, and there's the actual policy implementation, which tend to be a bit softened. That's at least my read.
Yeah, I don't know that I have a huge amount to say on that one. I would defer to John Kingston to write an article about it on that. But I don't know that is going to have, from my perspective, I don't think it has as much potential to be as impactful, mainly because America's already making. and that oil
the
is
oil
heavy.
is different.
Yeah,
it's
that
a different kind of oil going
and I don't
into
think
different
you
type of
can't
products.
make diesel out of that oil.
It's heavy.
Yeah.
It's really not ultra.
Not light sweet crude. It's the
really heavy stuff. Yeah.
Great. Next question here is from Michael, who asks, how much fraud is taking place in the transportation industry, and what is the cost to trucking rates and customers?
Oh, this is massive.
God.
It's so massive, and it's getting better. And, freight fraud is a major issue. It's growing exponentially, and it's going to continue to be an issue. But the platforms are going to have to take more leadership here, as we've talked about. They're certainly aware of the problem, but we want to see continued reinforcement. You see products that, whether it's RMIS or highway, that are attacking this problem as well. But this is a big issue, and it's going to become a bigger and bigger issue because it's so lucrative, frankly.
Yeah, it's an issue of economics. As long as you see that carrier details net changes in the red, fraud is going to be a huge issue.
And one of the things is like the Federal Motor Carrier Safety Administration, the one that issues the operating authorities, they will say and have said, A, they don't know if it's a problem, which is just a government official saying, I don't want to do this.
Right.
Second is, it's not technically in their charter to actually enforce it. It has to be a safety issue. Mm-hmm. So there's nobody to really enforce it. The market has to sort of adopt its own solutions. Mm-hmm. And law enforcement, and the other thing is just going to get, one thing about also talking policy again is, did you see this automatic resignation form thing?
He told me.
So the Trump administration said, basically we'll pay you for 7 months if you resign, and all you have to do is email the word resign as a response, which, by the way, I think is probably the easiest government form I've ever seen to understand and execute. But I think that's going to make government's job, or it's going to make it harder to change for government to enforce, even though national security and law enforcement were exempt from these decisions. Mm-hmm. It's going to mean that, and the FMCSA is not a law enforcement agency.
Right.
It means that you're much more likely to see the problem exacerbate, which means tools, solutions, private sector, industry is going to have to take a bigger role in this, or else it's going to continue to prosper.
Yeah, there's several products emerging from the tech sector and are doing very well because of that. But yeah, as long as the economics are favorable, it will continue to be a strong issue.
Great. Next question here is from Eric, who asks, as a shipper in the middle of a bid, what can I expect as a percentage for rate increases on average?
Oh, that's a great question.
I like
a typical market, which I think this could be described as a typical market, is 3 to 5%. 3% is usually sort of a typical contract market. I think we're in that range. I don't think at least I'm not hearing anyone that's thinking you're going to see in the 7 to 10s, which would be a bullish market. But I think inflation-adjusted increases is probably what you'll expect. So that 3 to 5% range. What is your inflation right now? Around 3%?
2.9.
2.9? Mm-hmm. So you're in that same range, and I think that would be what I would expect to happen.
Yeah, what I've heard, and our data supports it to an extent, is a lot of people are just saying, can you hold? And I'm starting to see a resurgence of mentions of shortening
mini bids.
The mini bids. Like, we're seeing shorter lengths of time for rates. They're just saying, hey, just hold what we got for now. Let's revisit in 3 to 6 months. And that's what I'm seeing a lot more of right now. because there's, again, we're certainly through the period where rate reductions have kind of ended. So it's kind of a flat to up market, the way I see it.
Super. Next question is from Joe, who says, what are your thoughts on the proliferation of tech influencing the spot market freight rates in nearly real time?
I would take the question to say the barriers of entry that existed 10 years ago are gone.
Yeah.
So in the great financial crisis that was in 2008, what happened during that freight recession is not only did the spot rates collapse, but so did these spot opportunities for small carriers, because the brokers were not representative of the market. They had such a small percent of the overall market share. The technology players, and it's everybody, it's the digital brokers, it's the incumbents, have created easier products to do freight. The marketplaces, all of those things really made it easier to get access to high quality freight. Brokers now play a core piece of the representation. That has eliminated a lot of the sort of like advantages that the large asset carriers had. You could read Heartland's earnings and ask yourself what's happened there.
Right.
But if you sort of understood the backdrop, they bought a lot of these over-the-road long-haul carriers. They really suffered that. Well, that's where a lot of the freight that was previously managed by asset carriers has gone into the brokerage market. That's what's happened. And so the technology business has made it much easier for people to get in the business, which has exacerbated showing up the total amount of operating authorities. And I think that's the primary they've been the primary beneficiary of all the venture capital investment that's been poured in.
Yeah, I think also we're going to see an increase in volatility. I mean, a lot of the technology, what does it do? It makes you faster, it gives discovery quicker. Some of these like routine tasks that kind of bog you down in the process and be like, well, I can quote, I've got 3 hours to quote something. Now it's talking about seconds and minutes.
The thing is, like, when we started FreightWaves back in 2016, or when this sort of business plan was first there, it wasn't really information in the market.
Right.
Like, I remember sitting down with people who run large brokers and be like, do we even need economics? Like, do we care about that? There wasn't really the proliferation of message boards to the degree that there are today. Facebook, some of these Facebook message groups were just starting. X, nobody was on X. LinkedIn even, which has become just a combination of everybody having a contribution and a bit of a cesspool of just like everyone having an opinion.
Social media.
That all of a sudden, like, people are talking about the market. The good news is if you can ignore the noise and pay attention to the fact that they are talking about the market, that has completely changed. But it's driven a lot of volatility.
Yeah.
More information has actually created, and look, we are a part of this as well.
Right.
The more information that's put out, the more information that does get put out, because everyone's got an opinion, good or bad, agree or disagree. And that has created a much more aware market. Because the market's more aware, that means volatility is increasing. So volatility is an irreversible thing. Information's an irreversible thing. If FreightWaves were to go out of business tomorrow, and it's not going to, but if it were, then the market would adapt and sort of pick up the slack. I'd like to think that at least for a short period of time they would miss us, but the reality is that if you follow the way markets work, someone would come in and take up that slack and it would be off to the races again. So the transparency element is irreversible.
Yep.
And volatility, because of the transparency, just becomes that much more exponential.
100%.
Great. Next question here is from Greg, who asks, what's your level of concern with personal saving rates continuing to decline month over month and year over year, and how dependent the economy and freight movement is on consumer spending?
I think we haven't talked about it, but I actually think some of the administration's policies that are not being talked about a whole lot right now, like all the headlines are on these mass layoffs in government or mass, whatever you can call them, sort of restructuring, tariffs, immigration. Those are getting all the noise. What I think most people who are sort of studying the economy are looking for is tax policy. Tax policy is going to have an enormous impact on the freight economy into the latter part of the year, because things like accelerated bonus depreciation is a big piece of capital spending. income tax changes, whether we're talking about dropping tips, the tax on tips, or even more, bigger. All of that's going to impact it. And so I'm more interested in what happens with that than I am about personal savings rates. As Americans have always found a way to borrow money. And while there has been a tightening in personal savings, because there's a whole lot, and consumer debt has gone up, it feels like the bigger question is, what does the administration do around tax policy in the latter part of the year? Because we're talking about the bigger dollars, the stuff that actually moves so much of the economy, the big capital spending, that manufacturing has been sitting this one out, by the way.
Right.
Like manufacturing has been, that's why the LTLs are largely weak, is the manufacturing, what was the last ISM data? It was negative, right? It was below 50?
No, we just cracked 50.
So we're just cracked 50. We're finally in a slight manufacturing expansion, but it's largely set out for the last 2 years. And I think because it has set out, it means that what will drive that are big tax policy changes that encourage capital spending. And I think that is the bigger element that I would look for. Obviously, housing and auto are big concerns because there's a shift between this administration's policies around cars and autos and the former internal combustion engine versus EVs. That is an issue. But when it comes down to it, manufacturing could come back, and we could see some concessions made on that will help consumers consume.
Yeah, and I wouldn't get wrapped around the personal savings rate either, because that world that we used to look at that number in has changed and is gone. Savings rates don't mean what they used to. That money's going in other places. It shows up in other places. The debt has been talked about, but you can't necessarily look at this debt now and compare it to historical consumer debt because of inflation and also the wage increases. Earnings per debt level haven't changed as much as that number would necessarily suggest. So, as Craig said, I 100% agree with that, but also don't just get hung up on one of these numbers, especially when you're looking at a long stretch of time economically.
We have not talked about one thing. I want to make sure we at least touch on it before we go, is FEMA and natural disasters. 100,000, I had to look this number up. 100,000 homes were damaged in North Carolina during the hurricanes. 100,000. 10,000, I think the number in California was like 10,000 was I think it may be up to 20,000. I haven't looked at it lately, but like there's far more homes. The amount of dollars, California is the biggest, these set of fires, the biggest natural disaster in US history in terms of dollars.
Right.
The amount of homes damaged is much smaller. Now the difference is that the value of those homes is much greater than they are in North Carolina. And the amount of money that is going to flow in to California is going to drive a lot. So one of the things I would also look for that we haven't talked a lot about is, how does the FEMA story play out, or the natural disaster story play out in the freight market? We know that every single time there's been a hurricane that has had a big impact, that has created a lot of freight demand in the rebuilding process. I think that's also part of the backstory here, and that we haven't spent enough time talking about, because I think it's something that should be talked about.
Yeah, and we haven't really seen it directly shown up in the data because it takes a long time.
And California is going to take 5 times as long as everybody else, because that's California.
Dave Chappelle started Saturday Night Live talking about the California wildfires, basically saying, yeah, the same amount of land burning in Mississippi I could do that for $600-700. So a good monologue to open.
It looks like that is all of the time that we have for today. Craig and Zach, as always, thank you for joining us, sharing your insights with us. And thanks to our audience for always joining us every month and asking such great questions. Be sure to mark your calendars for next month's State of Freight on Thursday, February 20th at 2 p.m. Eastern. And visit GoSonar.com for more great events and resources. Thanks, everyone.